Good evening and happy Tuesday. I am so glad we're here doing another live video. We are on episode 11. This is just going so quickly now. We are completely ramped up and we're doing this 3 nights a week, and it's been great, and I'm hoping that I'm able to help a lot of people out there. So I do need to remind you, please enable StreamYard. You'll go to the 3 little dots there on the bottom of the video. And when you enable that, it enables me to be able to see your comments. So if you comment and you haven't enabled StreamYard, it's just going to come up as anonymous. So I always tell everyone, every single episode, why I do this. Just as a quick reminder, there are many small businesses out there, especially this year, that may not be able to afford a bookkeeper. And so I am here to help the small business owners in order to allow you to have a little more confidence in your books and a little more confidence in your financials. So I want you to be able to read your financials accurately so that you know the financial health of your business. This is for management purposes only, not to go out and get a loan, not to make huge business decisions or anything like that. It is just so that you know what your business is doing, because you need to know whether you're making a profit or you're not. And you also need to know how much you are spending every single month in expenses. I don't know how many people I have talked to that have said, I've looked at my bank account, there's money there, so I'm good. That is wrong. That is so wrong. Please don't ever do that, because that will get you in trouble. You need to be able to go by all of your reports in order to make sure that there is more than enough money to cover all of your expenses, everything that goes out of your business. Why? Because things may not have cleared. You may have just written 50 checks to vendors and none of them have cleared your bank. So now you're looking at your bank going, oh, I've got more than enough money. But then you may have forgotten, oh, I just wrote 50 checks and now I'm going out there spending and things are bouncing. We don't want that to happen. You need to know your financial health. So today we're talking about COGS, also known as cost of goods sold, and expenses / prepaid expenses. What's the difference? I have had so many business owners put all of their materials expenses that they are billing their clients into an expense. And depending on what it is that you're doing, that's debatable. But ultimately it's wrong. Because one, if you are billing your client for any sort of material, it's a cost of goods sold. Now, there is a slight variation. So there's something called cost of goods sold and cost of services sold. So if you actually sell goods, if you sell an actual item, that would be a good. If you have a service like myself, I don't sell goods. I don't make them. I don't have anything to do with any of that. And I prefer it that way. But that would be a cost of services sold. So basically anything that you are purchasing with the intention of selling it, or better yet, expensing it to your client, you're going to bill it to your client on an invoice, that is a cost of goods sold, because you have purchased that item specifically to make money. So if you are in the construction industry, you are purchasing all of those building materials specifically so that you can build that structure, not for any other reason. That is now a cost of goods sold. Anyway, we always go into a little review before we get into the meat and potatoes section. So let's go on ahead and do that. Share my screen. Oh, that does not look good. I don't know what happened. I am not liking the sight of that. I don't know why that came up that way. That's not the way that I put it up. Okay, so last Thursday we talked about assets and liabilities, their importance and how to record them. And last week, I apologize again. I was so scatterbrained. I was finding so many errors in everything that I put up there, and I was trying to explain everything to you, and I think I did a disservice to you. So let's get into all of this again. I'm just going to touch base. I'm going to go through everything quickly, and I'm hoping that you get some value out of it this time. Oh, that looks better. Okay, so why are assets so important? Assets help you to generate revenue, increase your business's value, facilitate the running of your business, and can help you achieve potential savings. So when we're talking about assets, certain assets get depreciated. Why? What is depreciation? So depreciation is the reduction in the value of an asset with the passage of time, due in particular to wear and tear. What does that mean? Wear and tear happens whenever you have a vehicle, a building, equipment. Things just fall apart. You have to repair things. You often hear that when you purchase a brand new car, as soon as you drive it off the lot, it starts to depreciate. That means it starts to lose its value. The moment, not the moment you take a test drive, the moment you've purchased it and driven it off the lot, it has already lost value. And so accountants will always depreciate certain things, and bookkeepers as well. We actually create spreadsheets so that we always know how much the value is at any given time for a depreciation. It's called a depreciation schedule. Over years, assets get replaced, begin to fall apart, like I said, and eventually reach the end of their useful life. Yes, they have an end of their useful life. What does that mean? It means that, quite simply, your item, land is not included. I'll tell you that right now. Your item, your vehicle, your building, your equipment, as I've got on the example here, is they can only be depreciated for a certain amount of time. And this is per the IRS. You cannot depreciate it for longer than, I think a building is 30 years or 33 years. It's an off the wall kind of depreciation for some of them. So they go by a certain rate, they go by a certain amount of years. And that's what we as bookkeepers have to go by. And why are liabilities so important? So companies use liabilities to maintain a record of unpaid balances to vendors, customers, and employees. As part of the balance sheet, it gives shareholders and owners, same thing, an idea of the health of the company, and they represent an important aspect of supply and demand in the economy. What is a liability? It is a thing for which someone is responsible, especially a debt or financial obligation such as credit cards, loans, credit lines, and vendor payments on account. And if you remember correctly, and I hope you were able to get this last time, vendor payments on account is different than vendor payments by check. So when you're paying a vendor by check, you are paying immediately. That's it. A vendor payment on account would be like Central Valley Builder Supply or Home Depot, someplace like that, where they actually have company accounts that they can open for you, kind of like a tab. You hear of a bar tab on all of these TV shows and movies. A bar tab is something that the bartender will open up for you when you have a lot of drinks that you plan on getting, or if you're a regular attender. At least that's what I've been told. I've never been really a drinker myself, but you have given your word that you are going to pay on that tab or that bill for anything that you have purchased. So instead of them sending an invoice to you and then you pay by check, you get a statement that shows you've made all of these purchases. Excuse me, you've made all of these purchases, and the company, the vendor, has covered all of it. It's like a credit card. And then they're asking for their money back. So that is a vendor payment on account. It's the company, the vendor, holding everything. They're them paying for everything, holding it, and then you pay the vendor back for what they've already paid for. I hope that makes sense. Okay, so the meat and the potatoes. Cost of goods sold, also known as COGS in the accounting world, and expenses / prepaid expenses. What's the difference? So we went through all of this just briefly in the beginning of our series. I was going over the different chart of accounts, and these were a few of them. I gave the definitions and allowed everybody to see what the chart of accounts look like. And I actually pointed these out, but we're going to do more of an in-depth this time. So what are cost of goods sold, or COGS? The direct costs of producing the goods or services, as I said, cost of services sold by a company. This amount includes the cost of materials and labor directly used to create the good. This can also be called cost of sales. So let's take a look at what this looks like. Let me share my screen on my other monitor here. Make sure it looks funky for you. Okay, so this is the profit and loss, also known as an income statement. So you can see right here all of your income accounts. This is the sample company, so I'm not showing you. Craig's Design and Landscaping Services is not a client of mine, so we don't have to worry about any of that. This is a sample company that QuickBooks Online gives everybody. Well, I can't say everybody, gives everybody that has the accountant version, which is what I have. So these are all of your income accounts. What's an income account? Of course, an income is it's revenue. It's anything that you're making as sales. But we've also got discounts given, so that's going to be taken away from it. But they've actually broken everything down for what it actually was. You know, you've got design income, you've got everything for landscaping services. When it says job materials, these are not cost of goods sold. These are actually reimbursable expenses. So when you're creating an invoice for a client for work that was done, you've already purchased all of the materials, but now you have to bill the client. These are billable expenses. Labor, so this would be subcontractors, anyone that would have been working directly on installation. Your pest control services, and then they've also got a generic services here. But if you look down here, we've got cost of goods sold. Now, I always, for my clients, I break it down because they want to see exactly how much they're spending for each good or each service. So we've always got a pretty lengthy cost of goods sold on the report. But as you can see, $405 doesn't really jive with any of this. It should actually be more than this, a lot more. So this is your cost of goods sold. You can see your total income and now your gross profit. This is everything minus the cost of goods sold. So there is a place for it. Okay, let me stop my share. Sorry, had a little malfunction there. So what's next? Let me share my screen again. Okay, what are prepaid expenses? Prepaid expenses is a type of asset on the balance sheet that results from a business making advanced payments for goods or services to be received in the future. That is not necessarily true, and I'll explain that a little bit. They're initially recorded as assets, but their value is expensed over time onto the income statement, also known as the profit and loss, which is what you were just looking at. So what's the difference between an expense and a prepaid expense? An expense is something that's taken when you purchase something one time. So for example, meals, bank charges, office expenses like supplies, utilities, things like that. So you're going to make that purchase for something one time. So you expense it completely during that, at that moment. A prepaid expense is something that you take over time, like the definition says. It's entered as an asset, but it's chipped away at to accrue monthly for reporting. So if you report to the IRS on an accrual basis, then you would be using prepaid expenses. Now, it's not necessarily something that you pay for in advance, but you're going to receive later. Yes, that is one of the things, but this could be something that you are receiving every single month, but you paid for it once for the entire year. And it cannot go beyond that 1 year. It's only 12 months. Anything else, you need to reconsider how it is that you're paying. So examples would be insurance, prepaid insurance. I don't know if you've ever heard of that or not. So car insurance, health insurance, your E&O insurance, errors and omissions for us, things like that. If you have the ability to pay 6 months in advance for that entire 6 months or the 12-month advance, then you would put that in prepaid expenses. Yearly subscription fees. So if you've got your trade magazine that you really enjoy reading every single month and you get a brand new, they send you a brand new, I don't even know what to call it, series or episode, I don't know. They send you a brand new one every single month. But you may have paid for that entire subscription for the year instead, upfront. And then there's yearly software fees. Most software, you're not going to pay more than $200 for an entire year, maybe a little bit more. You know, things like Adobe Acrobat or your QuickBooks subscription, things like that. But I do know, I can tell you that if you have a bookkeeper that's doing your bookkeeping and you want that subscription, you're probably getting that at wholesale from him or her, and you cannot pay that on a yearly basis. That's done every single month. So we're going to take a look at how all of this looks. Let me show you that funky screen again. Okay, so this time we're going to go to the chart of accounts. And I actually did this just before our lesson today. Prepaid expenses. I created all of these journal entries. Now, I know that I told all of you, never do a journal entry, because that is for accountants and bookkeepers to do. It's for those that know where everything is supposed to go and how it's supposed to be done. But what I always do for my clients, if they really want to have some sort of control over their own books, is I will do a set of journal entries for them, and then I actually point everything out to them and explain it. And I say, all you have to do is open up this journal entry and hit copy. Then it's just a matter of changing the date or changing the amount if you have to. So here's what I've done. So I've actually used my own example here. So for bookkeepers and accountants, for tax preparers, it is not cheap for tax software in the least. This is per year. So it's $2,500 per year, and it goes up to about $4,000 a year, depending on the software. So obviously, most software will allow you to either pay for the year or pay per month. This is not the case for tax software specifically. We only have the ability to pay for the year. So what I've done is I entered the entire amount that's going into prepaid expenses. Now, I have done this to make it look as though we've been recording this all year. You'll see one journal entry for every single month of this year. And we have actually stated, okay, this is taking out for this month out of prepaid expenses, and this is where it's going. And you'll see the amount. So when I open up the journal entry, it's putting it into software expense and taking it out of prepaid expenses. So let me show you what this looks like on the report. So prepaid expenses is a balance sheet item. We're going to look at this for January. And you'll see the full amount for prepaid expenses taken in January. But now, if we start going through each month, you'll see it's now going down. And you can see it even better here. So now if we go all the way to December, excuse me, been doing this all day. Excuse me. Now you'll see December, there's only one payment left. I call it a payment, but it's actually a deduction. So when I click on this, now you see every single thing right there that's been taken. So now what does this look like on the P&L, the profit and loss? If we look at January, we're not going to see anything under software, nothing. They actually created this later on in the year. But if we look at February, we now have a software expense. Now, if we look at December, let's see here, we have almost the full amount. So every single month, that software expense goes up. And every single month, that prepaid expense goes down. So it's easy to keep track of. I always keep a spreadsheet with all of my prepaid expenses, actually all of my expenses. So any expenses that I have had to pay for personally, I keep a spreadsheet. For instance, my QuickBooks fees are still coming out of my personal banking account, and I don't know why. I just noticed that today. So what I have to do is create a spreadsheet that shows, okay, this is what was paid for personally for my business. But if I have a prepaid expense, for instance, if I was to purchase that software today or January 1st, then I would put who I purchased it from, and I would actually label it as prepaid expense. So then when I go in to create my journal entry to show all of the expenses that I paid out personally, I can actually list every single thing and then just do whichever account that it's coming out of. So then it's going to hit each category in the report correctly. And then, of course, the next month, I can begin taking from the prepaid expenses. So if I actually have more than one prepaid expense, which I do, then I'm actually going to see each and every purchase that I've made, and I'm going to see several different journal entries with different amounts that show me, okay, I've taken out this amount, this much, and it's been allocated to software. I've taken out this much, and it's been allocated to insurance. So it can be a tedious process, but when you're doing it just once a month and you have everything in QuickBooks already set up, when all you have to do is hit copy, it makes it a 5-minute process, and it makes it very simple. So it's actually a very easy thing to do. So you just want to remember, any materials that you are purchasing for the business that requires you to, well, that's going to involve your sales, that's going to involve building. For me, it would be my subscription fees for QuickBooks and things like that. Construction companies, it's going to be all of the materials, all of the permits, toilet rental, equipment rental, things like that. Anything that you are using in direct for the client, specifically for creating whatever it is that you sell or make in order to make the money, that is a cost of goods sold. You put it there. You do not put it in expense unless it is to maintain the business. So in other words, if you have, let's say you're a landscaping company that does landscaping for all of your clients, but you also do your own landscaping, and you're not paying yourself for that, which you wouldn't, you're maintaining your own landscaping. What you would do is actually put that purchase in with a note that actually says, purchase for parent company, or purchase for me, it would be Miss Elsie's Bookkeeping. And then you would put it towards materials expense. And remember, prepaid expenses versus expenses. Expenses are going to be something that you take immediately as a one-time purchase. Meals, supplies, things like that. Prepaid expenses are going to be something that is allocated over time. So insurances that you pay a year in advance, or 6 months in advance, no longer than a year. Remember that. For your subscriptions, maybe, oh goodness, I wouldn't say legal fees. That would be more of a retainer. Software expenses, things like that. So you want to make sure that you accrue them correctly. If you are a nonprofit, you are on cash basis. So you don't have to take prepaid expenses. You can actually take that in full the moment that you purchase. So you don't have to worry about doing anything on accrual. And you might want to talk to your CPA and find out, hey, are we on a cash basis or on an accrual basis? That is something that you need to work out with your CPA in the beginning anyway. For how they're filing your taxes, if they are filing your taxes, you want to make sure that you are using the basis that they use with the IRS. They will ask you if you are filing on a cash basis, an accrual basis, or something different. You can do a hybrid as well. So just make sure that however you are doing your books is the same as the way that you file your taxes as far as that basis goes. So you don't want to go and do a cash basis for all of your books and then find out later on that you're filing on an accrual basis, if that makes any sense. So that's all that we have for this evening. Again, as always, if you have any questions at all, you can find me on Facebook. Just look for Lisa Culverwell, or you can look for Miss Elsie's Bookkeeping LLC. You'll be able to find me there. Send me a private message and I will answer all of your questions. If you are a new bookkeeper, I've got a special group just for new bookkeepers where we've got experts right there on hand in order to answer all of your questions, all of your general questions. And we also have a brand new mentorship program that is available to new bookkeepers where we do one-on-one sessions just for your assistance. We assist all of you with whatever it is that you have going on at that moment. Any questions, scenarios, things like that. You've got transactions that you need help with, you don't know where to put them. That's what we're there for. So look me up. Yeah, again, if you have any questions, please don't hesitate to reach out and ask. I am always available. And I hope to see you tomorrow. We are having another series tomorrow. Tomorrow we're going over income and owner's equity. I don't expect that tomorrow's lesson will take a half an hour. Income and owner's equity, it's not a deep dive and it doesn't take that long to explain. So again, we'll be showing you on QuickBooks what that looks like and explaining everything, what it is, what the definition is, and some examples, and kind of like what we've been doing. And I'd probably carve out maybe 20 minutes for tomorrow's video. Thursday night, we will be doing episode 13 on the profit and loss and balance sheet. You've already seen both of them, but now we're going to do a deep dive. And then we are off for 2 weeks due to Christmas and New Year. So no videos, no series next week or the week after. So we will pick up again on January 5th. And again, hopefully I will see you tomorrow night, 7 p.m. Central Standard Time. Thank you.